Hello, Sector Watchers. Welcome to the 9th episode of Sector Spotlight on this Tuesday, the 26th of November. This is your weekly update on sector rotation and everything remotely connected to sectors' relative strength and/or rotational analysis. My name is Julius de Kempenaer, and I'm your host for today's show. With me, as usual, are Zag and Rachel for technology, mental, and moral support. This show is live and interactive, so do not hesitate to participate in the online chat. If you're too shy or prefer other ways of communication, email and social media channels are open 24/7. Ladies and gentlemen, this is Sector Spotlight. And welcome, everybody. I just got back from a trip to India, as I told you last week. So this is basically I went from Sector Spotlight back to the new Sector Spotlight with a couple of days in India in between. What am I planning to do today? Other than fighting off a little jet lag and processing all that I saw in India. We're going to do as usual, sector asset class view and overview. And then I want to take a look at some international stock markets. We'll have the break in between. We'll have any questions if you type them up in Slido. And we're going to bring the pair trade idea back. If you have any suggestions for a pair trade idea, and I know a lot of people have because I did get a couple of emails regarding pair trading ideas. Don't be afraid. Put them out in the chat box, and if it's a good idea or if we have time for it, then we'll look at them live. And obviously, the backup plan that is if you don't come up with anything, I did. Anyway, let's start with some sectors and what has happened over the last few days. So here's the asset class performance over the last 5 days since we last spoke, and very, very clearly, commodities were the big winner, and we had real estate as the big loser. Well, I mean that is real estate was already not very high on our list. S&P up like 0.4%, and if you look at it relative to the Vanguard Balanced Index, then not a lot has happened outside the commodity and real estate spread. If we do the same for the sectors, we'll see this picture here. Biggest gain for energy, healthcare, not so much for financials and discretionary. The S&P, we've put it already on a relative basis, so most of the sectors went up, but this is relative. So here's the S&P 500 at 0. Everything on the right-hand side there, from industrials all the way down to real estate. And here again, this is confirming what we saw on the asset class performance chart, was down. Now let's bring that onto a relative rotation graph and see if we see any specifics over there. Come on, here's my start at the asset allocations. And what we see here, this is the weekly chart. Let's just stick at the weeklies for the time being. The only asset class inside the leading quadrant is still stocks, SPY. So that's, if you look at the RRG here, that's a bit of a no-brainer. You still got to be with stocks, and you see the turnaround in commodities that had started last week, and we highlighted that rotation is now following through, carrying on, and it's now definitely rotating back down to get a bit high yield. Here's government bonds, IAF, and we got corporate bonds still inside weakening, but heading towards lagging. And here is real estate. Now, I don't want to go over all these charts, but the one that I wanted to highlight is the LQD chart, because it is inside weakening and very close to lagging and crossing over. But what I see here is kind of bullish. I mean, there is this triangle-like formation that could be a continuation pattern, and it seems as if we're breaking out now. This is for a day and a half, 2 days worth of price action for this week, so we got to wait a few more days to see if this close can actually hold up above that upper trend line marking that triangle formation. And if that does, then we could actually potentially see this corporate bond market turning back up. And corporate bonds and high yield stuff, that's pretty close to stocks. High yields, not very good, but stocks still good. So, I mean, corporate bonds could be a very good second or as a diversifier if you don't want to be completely vested into stocks. So I'm going to keep an eye on that LQD ETF to see what's going to happen there, because I do like this breakout here. If we move on to the various sectors, then we see a continuation of the trends that started already a few weeks ago, and we've been highlighting them here on the show almost every week. That is weakness still for utilities, real estate, staples, also discretionary. This relationship is, well, I'm not going to say worrisome, but it's kind of strange that they both move in the same direction, because usually staples and discretionary move in opposite directions. And actually the discretionary sector is actually pretty weak, but we're going to bring up the chart in a minute. Energy, we spoke about it last week. It was part of our pair trade idea. That sector is now definitely falling through. It is, if you look at the disconnect between energy and the other sectors, it's way out to the left, which means that it is in a relative downtrend. Let me bring up that chart for a second here. So here is the ETFs weekly, and we're looking at energy. So here's energy. You know, on a relative basis, this is very clearly a downtrend, and we'll see now that it's starting to get confirmed that this little hiccup here, or basically a flattening in the relative strength line, which led to the kind of hiccup in the RS ratio and RS momentum pushing above 100. That seems to be a done deal now, and RS momentum is already starting to roll over, and that's causing the rotation here inside the improving quadrant. Way below the 100 level on the RS ratio, very disconnected from the rest of the chart. So energy really a sector to avoid still at the moment. Let's have a quick look at that discretionary sector, because that is pushing further into the lagging quadrant. Here is discretionary. It is the relative strength that is absolutely weakening. I mean, this isn't really too bad. As a matter of fact, it could get to a bullish breakout out of this triangle-like formation. But as you know, a lot of the other sectors are already above these highs, if not to all-time highs. So the fact that consumer discretionary has not been able to take out these resistance level, that is causing the relative strength to turn over. So in itself, it's not really a bad sector. It's just not as good as the other sectors that we have at hand at the moment. Anyway, pushing hard and strong into the lagging quadrant. Another one inside, no, I'm going to talk about that later on, because that was my idea. The very good one here is technology still, followed by financials. I'm sure you all know those charts. You've looked at them a ton of times. Financials had a lot of velocity, a lot of big differences increasing in the week-to-week observations. That seems to have come to an end, but it's not rolling over. It's pretty much heading sort of sideways, so we're keeping up that bullish momentum there. Let's have a quick look at that chart. It's actually now basically, we're now like 3-4 weeks above that resistance level, so that's a confirmed breakout. Still good, and that bottom here, that rounding bottom in that relative strength line, is sending good signals for the financial sector. Technology, all good. Industrials came into leading, lost a little bit of momentum, but seems to be picking up again. That's good news. Otherwise, we would have had to reevaluate our take on the industrial sector. But for the time being, I'm pretty happy with what's happening. We're well above that 78.50, 79 resistance barrier. We haven't even corrected back for a pullback, for a touchback of that old resistance level to become support. So we're consolidating for the last few weeks, and looks like as if we're going higher. From a relative point of view, this sector still has a lot of upside left. And then obviously utilities, real estate, and staples on the weaker side. So the rotation that we've been talking about is basically just carrying on. The next group that I want to discuss with you is putting everything into a little bit more international perspective. One of the reasons I did that is because I already had that narrative in my mind, because I did an interview with Bloomberg Television in India last week, obviously focusing on the Indian market, but I had to put India into a global stock market perspective. And here at StockCharts.com, we can actually do that because we have that group predefined on the RRG page. If you scroll down, then you will see international stock market indexes. And there you are. Here, these are the international markets, and I actually have a accompanying chart list. It says regional equity indexes. Oh, here it is. Now let's see if we can find any interesting ones, and we just quickly toggle through a few of them. Russia is quite interesting because it until like 2 weeks ago, this was like a super strong market, and then 2 weeks, or 1 week and 1.5 days, or 2 days, because the market is closed there right now. This very sharp hook occurred. If we bring up that market, and this is all against the Dow Jones Global Index. You see that my settings for the indicators here are also against dollar DJW. That is the Dow Jones Global Index. And from a price perspective, there's nothing wrong with this chart. It's pretty good, but we're losing like a little bit here, and that is just this little hump here. And the fact that it is so sharp is, well, kind of negative, but the position on the RRG is still far to the right, together with Brazil and the Nikkei Japan coming there, still makes it a very strong market. But keep an eye for a reversal there from a price perspective. I don't want to see this dropping back between that 1400 level. If we focus on, okay, let's put India there for my Indian friends who are tuning into the show right now, because I made a lot of noise and a lot of marketing for the StockCharts Sector Spotlight show. I told everybody that they needed to tune in, and it's kind of in their time zone. That's pretty cool. The Nifty 500, that is the big stock index right there, is inside the improving quadrant and moving towards the leading quadrant. This week so far, it is just barely keeping up. It lost a little bit of that positive angle, that positive heading that it had. But if we look at the chart itself, then India is definitely a market that you might keep an eye on from an international perspective, and just, whenever you think that it is appropriate for your portfolio, just get your hands on that Indian ETF. I'm sure there is a ton of them. And especially when that market breaks above the 10,000 level, that is a big level. That's overhead resistance for more than 2 years. If India can break that level to the upside, then I expect quite an acceleration for that market. And man, oh man, are there a lot of people and a lot of investors there, and there's a lot of money available for stocks. So this could actually be a very interesting market to keep an eye on. Even if you're in the US, there are US-based ETFs that track the Indian market, so you can use those for diversification from your US holdings. Beware of the fact that your US ETFs are quoted in US dollars, so you will introduce a US dollar rupee risk in your portfolio. Telling you this to just be aware of the fact that what you see on the RRG with the dollar CNX500 index not necessarily reflects what's going on with your dollar-based ETF, because that's moved into US dollars, which from an American perspective is a good thing, because you then don't have the risk directly, but you still have it compared to the CNX500, but it's overseeable. So just be aware of it when you do stuff like that. The S&P 500 internationally is still inside weakening, but look at this, it's starting to curl up. And as we all know, when something is on the right-hand side of the RRG, it rolls into weakening, but manages to curl back up while inside weakening and start to move towards the leading quadrant. That's usually a good sign, because it means that this is the second or the third leg or whatever leg in an already established relative uptrend. So take a look at the S&P versus the Dow Jones Global, that we see that we had this uptrend here for a long time. That happened April. So if we scroll this one back to April, you see that was here, April 8th. We cross into leading, and then all the time, and this is, here is September 23, when we roll over. That is here, when the green line drops below the 100 level. That's the same one here. And we traveled through the weakening quadrant, and we now start to curl up. And that's the green line curling up right here. If that move continues, and there's no reason to assume or to see why it would not continue, it could push SPX back into the leading quadrant, and then the US market is again inside leading. Obviously, it's a big part of the Dow Jones Global Index, and the US will then be leading with the S&P pushing to new all-time highs pretty much every, I don't know, week. That's pretty bullish for US stocks. Where do you not want to be? That is Indonesia, that is Australia, the All Ords. This is Canada. Beware, my Canadian friends, your market is underperforming the rest of the world. And also be very, very careful with China. This SSEC, this is the Shanghai Stock Exchange Composite Index. Let's take a quick look at that one. From a relative point of view, touching support levels, but already putting in a new high or a high inside the RS ratio line below 100, and that's what you've seen here. That's what we've seen happening here. This is that high in the RS ratio level, and it's now moving back into the lagging quadrant. So China likely to be an underperforming going forward. Let me see if you have given me any suggestions to talk about after the break or questions. I'll be happy to answer them. And I'll see you in about 20 to 30 seconds. Don't go away, stay tuned. And we're back. Rachel, did we get any questions? I think from my screen I can see one coming in, or two?
One. It's from Kelly.
All right. What's it about?
She's asking if you could just better explain why people would want to use pair trades.
Well, it's a good question, and I'll try to explain that. If you buy a stock just long only, you just buy it at a level, then you're at risk for that price. So you buy that price, that stock at 100. You know, if it goes to 90, you lose $10. You know, if it goes up, you win to 110, you win $10. Pair trade is a way to hedge away that long only risk. So how can I best explain that? Let's say that you're bullish from a pair trade is always a relative play. So if you're bullish on, let's say, I don't know, Microsoft. You're bullish on Microsoft, and you expect Microsoft to beat the S&P 500 in whatever your time frame is, coming days, coming weeks, I don't know, whatever. So you want to play the relative performance of Microsoft. Well, if you just buy Microsoft stock, you're exposed to all of that. What you then want to do is, in a pair trade, you want to hedge away that market risk, because you basically only want to play the difference between Microsoft and the S&P 500. And you can simply do that by shorting the S&P 500, and that can be done in various ways. I mean, maybe we should spend a little bit more time in another show on the various ways and the various techniques that you can use, because you can obviously use straightforward stocks, just buy one leg and sell short the other. Clearly, you can buy options or use options. You can use futures contracts. CFDs is very popular here in Europe, contracts for differences. They're great for pair trading. So the reason why you want to play a pair trade is because you only want to play the difference. So Microsoft, you buy Microsoft and you sell SPY. That combination gives you the difference between Microsoft and SPY. And if your bet is right, if your view is correct that Microsoft's outperforming SPY, then if both Microsoft and SPY are going up, but Microsoft's going up faster than SPY, then you win. If Microsoft's going up, SPY does nothing, you win. If Microsoft's going up, SPY's going down, you win big. If Microsoft's going down and SPY goes up, that's obviously the scissor move that you don't want to see. But there is a correlation between the stock and your hedge. So they can go sort of in tandem. And the idea behind it is that you don't lose too much if you're wrong on the bet. Now, there are many ways that you can play that, being more aggressive or less aggressive. But the basic answer is, why do I want to play pair trades? To eliminate a certain amount of market risk. I think that's the best way to phrase it. So with that having said, nobody came up with suggestions. So all right, I need to do my own homework. That's good. That's fine. Let me go back, because one of the I actually got quite a few questions over email with regard to pair trades. People also telling me how they did it in a different way than what I did, because just to bring back to refresh your memory, what I did last week was actually go look for a stock with very high potential inside a sector with high potential, and on the other side, for the short leg, look for a stock with high risk in a sector with high risk. And we identified, and I'll show you another nice tool on StockCharts where you can actually run an RRG on the fly. We identified energy as a weak sector, technology as a strong sector, ExxonMobil as a weak stock, and Broadcom, AVGO, as a strong stock. Now, and here is what happened. This is what it looked like on the weekly. Now let's bring that to a daily so we can actually see what happened since we spoke. 5 trading days. And you see that the performance here is that energy. This is a very bad example because it went exactly against us, because energy went up and technology went up less. So the trade is going against us. But you know, my horizon is a little bit longer, and if I bring this to a weekly chart, you'll see why I want that. Because here, Broadcom is still pushing higher into leading, technology is pushing higher into leading, XLE rolled over, and some is still rolling over there. So I'm still pretty happy with the trade as such. It's just a little bit of let's say startup error, and we can see that if we do EVGO versus XOM, we'll get the chart. This is forget about those two indicators below because they don't make any sense right now. And you can see that we actually went in there like, this is 19 November. That is exactly 5 trading days ago. That was last week, Tuesday. And we went in around here, we dipped, and now we went back up. So this relative strength is still making higher highs and higher lows. So we're almost getting back to the entry level where we got in. So I'm still pretty happy with that trade setup, especially if you look at the RRG position on those weeklies. I think that technology and Broadcom are way better than energy and ExxonMobil. One of the people who wrote me an email he said, I prefer to do pair trades on ETFs, on sectors, rather than on individual stocks to avoid general sector risk. And that's cool. I mean, that is perfectly fine. I mean, there are many ways to implement pair trading strategies. And clearly here you have at least some sort of single stock risk or sector risk that could hit one of those stocks. And if you would play the sector, that would have worked as well. I mean, if look at those two sectors, I mean, I can see a pair trade where you're long technology and short energy. That's totally fine. We just dived in one level deeper, call it a little bit more aggressive to look for the individual stocks. So I took that view from that person that wrote me in the email, and I thought, let's see if we can find a pair trade based on sectors, and then you only have to trade sectors. You don't have to trade the individual stocks. So that brings me back to the chart, and I almost was too early in my sector overview because it actually looked very nice, and I wanted to tell you right away. But here is what I was looking at. If I go over these sectors, then I noticed this one here, that is healthcare, turning back up, and you see this hook here. And we're going to go to the daily chart in a minute, and then you'll see that this is actually a fast rotation on the daily chart. So this one I sort of had in my mind, hey, that's a nice hook up. That's a strong move. That's good. And then I continued further, and then I saw this one here. This is materials, and they're very close together, and that's always cool if they're close together and moving over. Now let me put XLV and XLB together, and then you see what's happening. They just almost identically reversed to each other, and you can actually hypothetically draw the vertical line here as a crossover from like improving to leading or weakening to lagging. These sectors are both underperforming S&P 500 because now the S&P 500 is the benchmark here, but you can actually draw that cross right here as well, and then you have that crossover. Now look at the weekly version of this chart, and you see a very nice opposite rotation. We're a couple of days late because what you actually, when you want to hit it, is like when you see stuff like this happening, when they just almost cross each other. That's sort of the ideal situation. So if you're into pair trading and sectors, then this is the type of stuff that you want to look at, when they just like cross over and then start to accelerate. Now let me bring that XLV, XLB onto a chart. XLV, XLB. Here it is. Oh, that's not what I wanted. Sharp chart. XLV. That is great. Go to this one. XLV, and then put it against XLB. XLB. And you see that this is nicely rolling over. This is the crossover that I meant to tell you. So I am now suggesting to look at a pair trade of being long. This is the old one. Healthcare around 99 and materials around 60. So take a look at it. Let me know what you think. And this was the 9th episode of Sector Spotlight. Thank you for watching. Please don't be a stranger and stay in touch. And I hope to see you back next week, same day, same time. Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern. And meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com. Or even better, subscribe using the link below each article to make sure you'll receive a nudge every time a new article is posted.